Hello traders, Gary Wagner here, just about 12 noon in Honolulu, 5 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the island. 27th day of December 2019, and this is the last weekly review and daily report of the year 2019. Of course, we'll be on for a daily show next week, but this is the last weekend review. And what an interesting week we had. Although we're ending on a very, very quiet note with fractional moves in gold and an extremely weak US dollar, we hit definitive benchmarks this week, beginning on Monday and then going throughout the week. It broke above the 50-day moving average. Day later, broke above the 100-day moving average. It also broke above the compression triangle that we identified. I believe that is a critical component. And lastly, above the 23.6% Fibonacci retracement. All four of these things occurred at the beginning of the week, and of course, that did prompt us to issue a buy signal earlier this week. We are long gold. We will talk about our specific trade when we pull up our technical studies, our stop, and most importantly, our exit strategy. But first, to the price boards. Traders, we did hit quite a few benchmarks this week. But as for today, you can see that gold closed up, but by only $1.20. February futures at 15.60. But that is a little bit deceiving. I've just put up the Kitco Gold Index. This is showing, of course, the spot market, and the spot market closed down about 50 cents, but at the time I took the screen print, it was down about $1.10. And if you take it apart, a weak US dollar actually contributed $8.80 to the value, and normal trading was definitely dominated by sellers today, taking it down $9.90. Net change when the screen print was down $1.10. It is down about 50 cents currently. Platinum did close lower, $6.70, 946.80. Palladium did close higher by about 0.3%, 1875.10, and silver lost almost a full percentage point, 0.9%, 16 cents, still shy of 18 at 1783. But the key today was dollar weakness, giving up almost 0.6% at 96.55.5. Let's take a look at our current studies. This was truly a week in which we witnessed gold break out and break out strongly to the upside. As you know, we have been looking at a market that really can be defined in terms of the highs by a series of lower highs. But in November, the lower lows changed to higher lows, and that's what created this bull pennant formation or compression triangle, was the series of higher lows and lower highs. Now, the theory behind this is as the market approaches the apex, energy builds up because the range compresses, and we will get a solid break either to the upside or downside when the energy is released, and that move should be sizable. Now, typically what we look for is for the market to break to the prevalent trend direction, which we can certainly see is up. And that's exactly what happened. When we broke out at the beginning of this week, we broke out and closed above the 50-day moving average as well as above the compression triangle. Now, what followed was an intense market move, this occurring on the 23rd or Tuesday, and we had about a $15 rise, now taking it above the 100-day moving average, as well as the 23.6% Fibonacci retracement. And that was the criteria that we were looking for to enter the market. We took a stab at the market, and we entered it on the open on Christmas Day, the evening of Christmas Day, when the European markets opened up and got in at 15.0550. We placed our stop just below the low of this candle. Currently, we have gold at 15.60. Now, based upon recent activity in the market itself, we have to acknowledge that today's move came right up to approximately 1520, where we have identified a minor level of resistance. I believe that the next level above that is 1540, but I do not foresee these being as major resistance levels. In fact, I think that the major resistance level comes in at around 1565, and that is based upon the yearly high, or this top right here, the conclusion of a third wave. Also, when we look at our Elliott wave count and the extension or projection to where the system believes we could see this fifth wave conclude, it comes in at approximately 1630. This, of course, is a very short-term model using a daily chart. Now, nonetheless, we will get a series from the beginning of this in which we will see the market move up to a certain point, correct, and then go through a series of 5 waves. So it's not going to be a straight target up, but I believe that this price, 1630, is absolutely achievable over the first quarter of 2020. This has been Gary Wagner, wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for the final week of trading in 2019. Have a great weekend. Bye-bye.